The subject of this week is how to build a $1 million stock portfolio for beginners. So let's start by asking the question, is it really possible to build a $1 million from scratch? The answer is absolutely 100% yes. And let me start with a real story that happened. Let's call her Sarah just for the confidentiality. I met Sarah a long time ago. I was working in Geneva, in Switzerland. And she knew that I have the passion of investment and stock market and real estate and so on. So she came and she asked me to check her stocks portfolio that she had in UBS. She had a good amount. She had at that time around 300,000 Swiss franc. I asked her, how did you accumulate that? Because she was really young at that time. So she told me very, very simply, Haitham, every month I automatically save 30 to 40% of my salary and I put it on that UBS fund. How long have you been doing that, Sarah? She told me she has been doing that for the last 10 years. At that time, she was in her early 30s. And I checked the UBS and I told her, look, it is not bad, but you can do better if you really learn how to build your own portfolio, because normally banks will always prefer to put in funds that give them money. So it's always better for us to do it ourselves. We had the discussions and I shared with her some thoughts and she started to learn about the investment in the stock market and then the CEF and ETFs and so on. And then we put a plan together that every month she will save the 30-40% that she was doing, but in a certain portfolio with a certain balance and certain diversification among many of the investment segments that I will talk to you about it later. That was in 2019. 2019, she started following the portfolio that we built together. And then 2020, there was a corona, all of us know, and a huge crash happened in the market. So what did Sarah do? Did she panic? Did she sell everything? And she said, no, Haitham, my money that I have been working to invest for the last 10 years has been down by 30%. Actually not. She were very, very consistent in the 30-40% addition, despite the volatility of the market and despite the big crash that happened in 2020 because of the corona. Then 2021 was extremely good. And then 2022, you all know the stock market was down almost 30%. And she did not deviate. She kept adding the 30-40% every month. And she put it in the diversified portfolio that we built together. And she does not keep selling and buying. We do only the balancing of the portfolio on a quarterly basis. Today, I opened the portfolio and she has 1.3 million Swiss franc. So it is possible. It is really possible, and it depends on 4 steps that I will share with you now. And please take a note now, because here I'm sharing with you something that I have done by my hand or with other people. So please take a note and, more importantly, take action. Step 1 is what I call the money mindset. That is a foundation that you need to have in order to build wealth. There are 3 important points under money management mindset. Number 1 is you need to make sure that you spend less than what you earn. Warren Buffett said a great statement here. He said, don't save what is left after spending, but spend what is left after saving. So you never accumulate debt and you spend more than what you earn. Point number 1. Point number 2, you need to automatically save For me, the minimum is 20%. Can go up to 30, 40 like Sarah, can be 50, 60, 70 if you are still single, you're still living with your parents. Make sure that you have that percentage saved and then invested after. And then the third one is for you to know the concept. I learned that concept from Robert Kiyosaki. You learn the concept of assets and liabilities. Assets are the things that, in a very simple way, he explained it extremely well. He said, anything that put money in your pocket is an asset. Anything that take money out of your pocket is a liability. A car is a liability. A TV is a liability because it take money from your pocket. However, an apartment that you rent, put money in your pocket, so it's an asset. A stock portfolio that give you dividends that grow with time, capital growth, also is an asset. So this is the third point. Make sure you accumulate assets and avoid liabilities as much as you can. Of course, we will always have some liabilities. However, we need to avoid as much as we can. So that is the first step, the money management mindset. Second step is to start as early as possible. Build your diversified portfolio. And it doesn't matter how big it is or how large amount that you have. You will see the 4 steps that I'm going to mention to you. I did not say you need to start with the magic number and so on. You can start from zero. So build diversified portfolio. To build a diversified portfolio, first step, you need to have a brokerage account. So you need to have an account that you can invest in the stock market. So you can search the internet now. It's extremely easy. I used many of the brokers, and I ended up now I have my interactive brokers app allow you to invest in many of the categories that I'm going to mention. But you can use other things. Saxo Bank, I use Sarwa here in the UAE. There are many. So that's not the main problem. The main problem is you start building your own diversified portfolio. The word diversified is extremely important here. Diversified means that you need not to put all your eggs in one basket, as they said. There are 4 main categories of investment that you need to diversify your money across them. The percentage of every category will differ from your appetite for risk, your age, and so on. So what are these 4? Number 1 is the stocks. We call it equities. Equities is an ownership in a company. So when we buy a stock of Apple company, we own part of Apple company, even if it's small, but we own part of Apple company. So that is the first category of investment, stocks. And it has different forms. It has an individual stock, so you can buy directly in a company, or it has also what we call funds, like ETFs and CEFs, and we will explain that later. And normally, what is the percentage for stocks that you put in your portfolio? There is a very simple equation that we learned in our finance trainings and courses and certifications and so on. They tell you it's 100 minus your age. So to give you an example, if someone is 40 years old, then he needs to put 60% in stocks. 100 minus his age 40 is 60% in stocks. Second category is real estate. Real estate is extremely important. Someone will ask me, oh, but real estate will need a lot of money to put as a deposit, and then after that to pay the mortgage every month and so on. But you can buy real estate through your broker account. They call it REIT, Real Estate Investment Trust, REIT. These are companies that buy real estate, and you buy share in it as if you are owning part of all the real estate portfolio. They are collecting the rent and they give it to the shareholders. So normally you find the dividends of these companies are extremely high. So this is how you can get investment in real estate until you build enough money to put it in a deposit in a physical real estate, which is again an amazing way of building wealth as well. So that is the second one, the real estate. The third one is gold and silver and precious metals. You need to understand also the benefit of investment in gold, because sometimes people just buy gold without knowing what is the benefit of that. Gold is a hedge or is a protection against inflation. So if the prices are going up, gold will hold the value, will help you to protect against inflation. Second is against devaluation, and the people who live in many countries like Egypt will understand that, because now the power of the Egyptian pound or the Turkish lira or many of the currencies that have been devaluating in the last few years, they lost their purchase power. If you put it in gold, that will not happen. By the way, in the last few years, the gold increased massively. Why? Because inflation was high across the world, plus devaluation in many currencies. So that is the third one, gold and silver. What is the percentage of the portfolio for gold and silver? The people I learn from, they give us a range from 5 to 10%. So 5 to 10% you need to put in silver and gold. Then the last one is fixed income. Fixed income is the bonds, is preferred stocks. That is money that you put for a exactly certain amount of money that you get either every month or every quarter or every year. So these are the four categories that you need to build your portfolio. The percentage, as I said, really you need to decide, depends on your age, on your risk appetite, your financial goal, and so on. So now we talk 2 steps to build the $1 million. Number 1 is the money management mindset. And then the second one is build your diversified portfolio. Third one, which is extremely important, is be greedy when everyone is fearful, and be fearful when everyone is greedy. If you look to the last 20 years, there were huge crashes of the market. 2000, the dot-com. 2008, the financial crisis. 2020, Corona. 2022, with the increased interest rate. And let's learn from Sarah's story. What happened when we had these issues and these crashes? She kept investing. Majority of the wealth that has been built in the stock market was thanks to these crashes, because the people who know how to invest in the stock market, they put the money at that time. This is where you can make money. By the way, it's a good news. Almost every year there is what they call correction. Correction means that the market is down by around 10% from the peak. That's a very good opportunity. So every year you have an opportunity. Second is the bear market or the crashes happen on an average every 7 years. But recently it happened a bit more frequently. So because 2020 was a crash and then 2022 was a crash. Okay, so this is the third step. Be greedy when everyone is fearful, and be fearful when everyone is greedy. And then the fourth one is to be very consistent and patient. The stock market is not a sprint. Please, anyone will tell you you can do this $1 million in 1 year. I'm telling you, be very doubtful. It needs patience. It needs consistency. You will reach there. You will reach there. But be very consistent and be very patient. At the end, you can ask, okay, so how long it will take me? I will give you a website, a very nice one. You can put all your assumptions and you will know how long it will take you. The website called calculator.net. You can put the initial amount that you have. The stock market return, by the way, in the last 50 years was around 11-12% year on year. So you can assume that you will do 11 to 12% per year. And then you can see the initial amount and you can put, I need to reach $1 million, and see how long it will take you. It will all depend on how much you are adding money, but it will also depend on how good you are as an investor. So this is why you have to learn. You don't just put the money without learning. You need to learn how to invest. And then the third one, you can really think of adding all your, not only the monthly 30-40% that we said, or 20%, but also all your bonus. If you get a promotion and you get a salary increase, for example, put all that remaining to your portfolio, because at the end it's not about the $1 million that you will save. It's about the freedom that you will get. It's about the security. It's the feeling of security. Many of us, they come to me and they talk to me, tell me, well, we are working in a job that we don't like. Okay, so why not to leave? Because I cannot afford. Having that amount of money will give you that security, that freedom, that you can change the job even if it takes you few months to find another job, or even a year, you still have enough money to support you during that time. So if you like the video, please, I would like you to share. Spread the learnings, spread the benefit to everyone, and write in the comment or send me an email to info@wealthheights.com with any questions that you have. I'm here to support you and to help you, and see you next week in another video. Yeah, bye-bye.